Understanding what your venue has earned versus what's simply been paid is key to accurate end-of-month reporting. Roller's accounting reports help you separate payments from earnings, apply cash or accrual accounting correctly, and confirm tax amounts for the period. In this video, you'll learn how to use Roller reports to understand monthly earnings, tax payable, and financial balances with confidence. Roller lets you view your data using either cash or accrual accounting. Cash accounting recognizes revenue as funds received immediately upon payment. Accrual accounting recognizes revenue and tax when services are delivered, when guests redeem tickets or bookings expire. This difference affects which month revenue and tax appear in. Here's a common scenario. A guest books online on February 27th for a visit on March 3rd. The payment is collected in February, but the service isn't delivered until March. Under accrual accounting, that payment appears as deferred revenue in February and becomes earned revenue in March when the guest checks in. The Revenue Recognition Report is one of the most powerful reports in Roller. In this video, we're using it at a high level to understand month-end earnings and timing. It tracks three types of activity: transactions when payments are taken or refunded, recognitions when tickets are redeemed or expire, adjustments when bookings change or are canceled. Each entry shows the product, booking, amount, tax, and date, so you can see exactly how and when revenue is earned. Let's go back to our scenario. The guest who booked online on February 27th for a visit on March 3rd. On March 3rd, when the guest checks in and the ticket is redeemed at POS, the Revenue Recognition Report records a recognition entry. This moves the value from deferred revenue into recognized revenue for March. Revenue is split across all items in the booking based on the percentage of the total booking value that each item represents. For example, if a booking includes 3 items valued at $50, $25, and $25, and a payment is made, revenue is allocated proportionally, 50% to the first item and 25% to each of the remaining items. This ensures revenue is distributed accurately across products in the Revenue Recognition Report. Under cash accounting, that same revenue would have been recognized as funds received on February 27th, the day the sale was made. This is the moment revenue is earned under accrual accounting. This is the expected pattern. Payments for future visits increase deferred revenue. Redemptions or expirations reduce deferred revenue and increase earned revenue. If a booking doesn't move from deferred to recognized when you expect, that's your signal to check redemption timing or product validity settings. Beyond checking individual bookings, the Revenue Recognition Report is also the foundation for your accounting reports. The summary figures you see in reports like ledger summary, trial balance, and sales tax are built from the transaction and recognition entries recorded here. If you ever need to understand what makes up a summary figure, whether that's funds received, net revenue, or tax payable, you return to the Revenue Recognition Report to investigate the detail behind it. Next, use the Ledger Summary Report to group earnings and tax by reporting category, also known as a general ledger, or GL code. GL codes help align your Roller data with your accounting system, grouping revenue into areas like tickets, food and beverage, or merchandise. We recommend setting up your GL codes in Roller to match the account codes used in your accounting system. This makes exports easier to reconcile and reduces manual adjustments when working with your bookkeeper or accountant. This makes exports and finance reviews much easier. To review tax specifically, open the Sales Tax Report. This report shows taxable sales, where tax applies, non-taxable sales, such as 0% tax items, tax payable, based on recognized revenue. This is especially helpful if your venue uses multiple tax rates. Finally, use the Trial Balance Report to confirm everything lines up. In simple terms, debits represent money received. Credits represent revenue earned or liabilities created. For example, when a guest pays for a future booking, That payment shows as a debit and increases deferred revenue as a credit. When the guest checks in, deferred revenue decreases and earned revenue increases, keeping the report balanced. If totals balance, your books are aligned. If there's a variance, the revenue recognition report helps you trace why. These reports can be used together, depending on what you're checking. Use revenue recognition to confirm what was earned. Ledger summary to group results by reporting category. Sales tax to validate tax payable. And trial balance to confirm balances. They support accurate reporting without forcing a fixed process. When you need to validate or share these figures, export each report using the same date range and reconcile totals across revenue recognition, ledger summary, sales tax, and trial balance. You've just learned how to use roller reports to distinguish between paid and earned revenue, apply cash or accrual accounting, and confirm tax amounts for the month. You're ready to produce clearer month-end numbers and share them confidently with your finance or accounting team.